Tencent. It was the late great Charlie Munger's final investment. Is it really a great stock, or did Charlie Munger make a terrible mistake? Hi, welcome to Global Value, and in this video, we're going to dive deep into a fundamental analysis of Tencent stock, ticker symbol in the United States, TCEHY. We will use methods from Warren Buffett, Charlie Munger's business partner and one of the greatest investors of all time. We'll study the key numbers that Buffett and Munger valued most, and then we'll figure out 3 different prices for Tencent to really understand what it's worth in today's market. Stay with me till the end because our final fair value and rating might just surprise you. And there's more. I'll also share a special bonus that could be the deciding factor when adding Tencent stock to your portfolio. So is Tencent a great chance to make money? Let's find out together. Right now, Tencent stock trades for $36.79 per share. 2023 was really rough on Tencent. Their stock price was down 25%, while this underperformed the market, and the S&P 500 was up more than 20%. But there's more for shareholders. It's not much, but Tencent right now pays a 0.73% dividend yield. Those dividends are added to any returns in their stock. In the last 5 years, after beating the market until 2021, Tencent stock is down 15.5%. In the last 10 years, it's a totally different story. Tencent has actually beat the market over this time. They compound at exactly 10% annually. When we go back to the global financial crisis, since their listing in the United States, Tencent is one of the top performers in the last 15 years, compounding at more than 25% annually when we add in their dividends. They've crushed the market over this time, even if things have been rough on the company recently. But the burning question is, why should we be paying close attention to Tencent? Right now, the company trades less than $2 above their 52-week low. This comes as they trade more than $14 below their 52-week high. And how big is Tencent? They're absolutely huge. One of the biggest companies in China, they have a $343 billion market cap. So what does the company actually do? Tencent is arguably the most influential internet firm in China, as one can hardly go by a day without using its products. Tencent is the world's largest video game vendor and owns the world's top-grossing mobile game, Honor of Kings. Tencent's also a shareholder in Riot Games, maker of League of Legends, and Epic Games, maker of Fortnite. Tencent also runs China's largest social media super app, WeChat. The app is now part of the fabric of life for Chinese people who use it to chat, shop, watch videos, play games, order food and taxis, and more. Equally as impressive as its own portfolio, Tencent is also among the world's largest venture capital and investment corporations. The firm is now one of the largest shareholders in leading tech companies like Meituan, JD, Didi, Snap, Pinduoduo, Kuaishou, Epic Games, and more. Charlie Munger bought Tencent as his last investment for the Daily Journal Corporation. He managed their portfolio up until his death at the end of November 2023. Special thanks to Bill at @WaBuffo on X. He looked at Daily Journal's corporate filings and sleuthed out that Munger indeed bought Tencent as his final position, most likely buying shares on the Hong Kong Stock Exchange. This came after selling nearly half of his Alibaba stake, with nearly an 18% position in Tencent and 50% exposure to China overall in this portfolio. In one of his last interviews with Stripe co-founder John Collison, Munger revealed that 18% of his personal portfolio is invested in China. Now with that understanding, let's dive deep into the numbers that Warren Buffett and Charlie Munger care about. This step-by-step checklist-style approach reverse engineers how they would look at a company's numbers. It gives you one of the best shots of finding undervalued, high-quality stocks that can beat the market, and make you a lot of money in the process. Getting started with metric number 1, we want their average return on capital to be above 14%. This helps us understand how much the company makes for all the money invested into it. Over the long run, stock returns are about a company's return on capital numbers. The average business earns 7% return on capital, so when we look for a benchmark that's double this, we can build in margin of safety based on the quality of the business. Historically, Tencent had some pretty amazing return on capital numbers, but these had declined in all of the last 5 years. Things are starting to rebound now. They're up in 2023, but in 2018 they earned 14% returns on capital, and in 2022 they earned just below 8%. When they're averaged out, Tencent earns 11.5% returns on capital in a given year over this time. While it's above average, it's below our benchmark. This is an X on metric number 1. But look for these to keep climbing into the future. Next, we want growth in their sales, earnings, and free cash flows. Simply put, it's harder to make mistakes investing into a great business with high returns that's growing. From 2018 until today, Tencent has grown their sales by 80%, their earnings have more than doubled, and their free cash flows have grown by 83%. This comes even as the company faced regulatory scrutiny along with other Chinese tech companies in the last few years. It's growth across the board, which is what we want. It's our first check on metric number 2. In our third metric, we want earnings per share growth. This looks at Tencent from the view of an individual shareholder. It can help us figure out if they're adding value for shareholders or not. In this time, Tencent has grown their earnings per share pretty consistently. In 2022, they earned $2.80 per share, and in 2023, in their last 12 months, they earned $2.75. This is more than doubled from where they were at in 2018. At the same time, Tencent's kept their shares outstanding pretty much flat, diluting shareholders by less than 1%. That's not much to write home about. With growth here, it's another check on metric number 3. How will the company do in the next half of our analysis? Our fourth metric is similar, but it's even more important. We want free cash flow per share growth. Free cash flows are the lifeblood of any business. Ultimately, it's how most businesses, including Tencent, are valued. We'll use 3 different ways later in our video to value Tencent based on their free cash flows, so stay tuned, you won't want to miss them. Tencent has grown their free cash flows per share over this time. They brought in $1.45 in 2022, and in their last 12 months, they brought in $2.15 for each share they had outstanding. It's another check on metric number 4. So far, we have 3 checks and only 1 X. Before we look at their debt and figure out what they're worth, why don't we check in on our bonus? Right now, Tencent pays a 0.73% dividend yield. While these are modest payments to shareholders, we want them to be sustainable. We want their cash flows to cover their dividends. In this time, Tencent's both grown their dividends and their cash flows, including on a per-share basis. They have plenty of room to keep paying out dividends compared to their cash flows. It looks like these are pretty stable compared to where the business is at, especially right now and in their recent past. Exactly what we want to see, it's a check on our bonus. Now, great companies can grow and earn high returns without using a lot of debt, and Tencent is no exception. We want Tencent's net debt to be below the sum of their free cash flows. In the last 5 years, they've used modest amounts of debt, growing this to $10 billion at the end of 2022. Today, they sit at just $1.4 billion of net debt. This is what we get after we subtract their cash and short-term investments from all of their debts. In the last 5 years, when we add up their free cash flows, Tencent's brought in $96.7 billion worth. That's huge compared to their debt in any year over this time. They could pay off all of their maximum debt with just half a single year's worth of free cash flow. They bring in a ton of cash. This is a massive check on metric number 5, as they use very reasonable debt in their business and bring in these huge cash flows. Now, how much is Tencent possibly worth? Metric number 6, the big metric of them all, we want their average free cash flow yield to be above 5%. This estimates what a stock is worth when an average of its free cash flows in the last 5 years is divided by its enterprise value. It's around where the S&P 500 has traded historically. Enterprise value looks at a company more like it's a private business by taking their market cap and adding their net debt together. Right now, Tencent has a $352 billion enterprise value. Over the last 5 years, in an average year, they brought in $19.5 billion. When we divide that by their enterprise value, we get a 5.5% average free cash flow yield, above that benchmark we're looking for. Today, in their last 12 months, Tencent brought in $24.2 billion of free cash flow. When that's divided by their enterprise value, it gives us a 6.8% current free cash flow yield, also above what we're looking for. Either way, it's a check on metric number 6, but don't just run out and go buy the business. Watch to see our other 2 estimates before you stay till the end of the video for our final fair value and rating. Everything we've covered so far is important, but there's something missing. This brings us to our second estimate, where we use a DCF valuation to figure out what Tencent might be worth. Here, we'll take their free cash flows and use historical assumptions to grow these into the future. Then we'll add in their tangible book value to estimate their net worth. They've been very predictable in their past, but you still have to do your own homework on these assumptions. If their free cash flows grow at 10.5% in each of the next 10 years, then in the following decade, if this growth rate is cut in half and they grow at just 5%, if we want a market-beating 15% rate of return, which is what Warren Buffett looks for, an estimate of Tencent's fair value is around $45 based on today's multiples. Keep some key points in mind. Tencent may look very cheap compared to where they've traded in the past. Right now, they trade just for 12 times owner earnings. Historically, in the last decade, they traded closer to 24 times. That's very similar to their EV to free cash flow. And more crudely, they trade at 13 times earnings with a median 10-year valuation of 35 times earnings. Any way you look at it, Tencent's trading very cheap compared to their past. Our third estimate takes their guru focus value. This comes in at $48.50 with a modestly undervalued rating. It uses historical valuations, an adjustment for their past performance, and analyst estimates for the future to give another perspective. For their valuations, anything based on their earnings or free cash flows looks pretty good. Tencent's pretty asset light, which is why their tangible book and gram numbers are down. That's to be expected with this type of business. Now, we've looked at most of the numbers Warren Buffett cares about, but it's the qualities of a company that are even more important to him. Why don't we learn what these qualities are for Tencent before we combine them with our estimates to figure out their fair value? Let's start with the long thesis. Number 1, many of Tencent's products are still in the early stages of monetization. Number 2, because Tencent is so deeply integrated within the Chinese daily life, it can easily test out new monetization methods and pick the best ones to implement. Number 3, compliance costs can rise to the point where they become significant barriers to entry to the Chinese internet industry. But it's not all positives for Tencent. Let's look at a short thesis as well. Number 1, Chinese regulators have become more assertive in recent years. There is always the possibility that the government may want more control over internet businesses by curbing monetization, limiting collection of user data, or restricting acquisitions. Number 2, Tencent found success by riding the wave of mobile internet, but this is no guarantee that it can stay at the forefront of next-generation technologies. Number 3, there's the possibility of highly competitive foreign internet service providers re-entering China over the next 10 to 20 years. Recently, Tencent's aggressively bought back their Hong Kong-traded shares, especially as their stock declined to start 2024. On the deal-making front, they're in talks with ByteDance to buy their gaming assets, and they're potentially providing financing for a Skydance Media acquisition of Paramount assets. This far in our fundamental stock analysis of Tencent, stock ticker TCEHY, we learned they go 5 for 6 on the Select 6 analysis. They've grown, they earn above average returns even with regulatory scrutiny. They have very small amounts of debt and huge free cash flows that may look attractive compared to their valuations. In the past, value investors Thomas Russo and Tweety Brown held small positions in Tencent's ADR. As of right now, no super investors hold Tencent's ADR, which is listed in the United States. Charlie Munger and possibly Li Lu own Tencent through their Hong Kong exchange traded shares. If Charlie Munger held Tencent, then his investing partner Warren Buffett did too, right? Well, not quite. Chinese geopolitical risk is one of the few places Charlie and Warren saw things differently. After briefly holding a small position in Taiwan Semiconductor, Warren Buffett sold out of that for a gain, and he's been selling a mutual position of his and Charlie's. He's also been selling his BYD stock, a Chinese company that's the world's leading electric vehicle manufacturer. So where Charlie Munger was willing to take geopolitical risk to get high-quality companies on sale, it looks like his investing partner Warren Buffett is not taking those same risks. Time will tell which is the wiser choice. Keep in mind this isn't financial advice. It's not a buy or sell recommendation of any security. Use common sense and do what's right for you personally. When we combine their qualities and their estimates together, today it looks like a possible fair value for Tencent is around $45 per share. Fair value is a range on either side of this number. It's $8 above their current stock price, but $20 down from their street target price, giving Tencent an undervalued rating. If you enjoyed today's Tencent stock analysis, like it, share your thoughts in the comments, and subscribe to the channel for more. Watch this next video if you're interested. You may enjoy it too.